Good afternoon, this is Todd Colvin coming to you from the floor of the CME Group. We are looking at rates. 10-year note yields remain in the old new range, I guess you'll call it. The 280 to 290 range, one that we had spent a great deal of time in until we catapulted north to 3%, got above 3%, actually got above 310, and then very quickly, it took about 5 to 6 weeks for us to get from 280 up to 312. We came back in about maybe 10 days. So we came back very quickly down to high 270s. Now we bounced up. We're hovering in those 280 yield range. Essentially what we're seeing here is we're seeing a lot of markets correct, rebalance we'll call it. But we haven't seen that same extreme in treasuries yet, as the risks are, fool me once, shame on you, fool me twice, shame on me. And I think that what we're seeing in treasuries now is that we're not going to see those shorts reestablished. We're not going to see those sellers come out as aggressively, given the fact that while there is some peace, there is some calm in Italy, the problem hasn't been solved yet. And I think that now you're starting to see that reflected in treasury yields. Equity markets are kind of all over the map, and we've seen the currencies kind of re-gauge, rebalance themselves, but treasuries haven't been as forthcoming. So they are remaining with alert, we'll call it on yellow alert in treasury space. And if you look at market volatility, we got to our highest since first quarter over this whole period of Italy. And I think that right now we've kind of taken a short pause from the rally in volatility, which is necessary because obviously the risks are very great. And they've been there all along. We just haven't been pricing them, and we saw a massive shift in market volatility higher. Now, as we look ahead, we have employment tomorrow. Now, employment, a lot of people put a lot of eggs in that basket for, well, strong employment and then higher wages are needed to move this market. I don't think so. I think at this point, the only thing that's going to move the market tomorrow is if we see a weak employment report with weaker wages. Because right now the status quo is already priced, and if you take into account what's happened in Italy, I think that only hurts treasury yields to the downside. You're going to see more buyers if these numbers aren't strong, as opposed to seeing sellers if they are strong. So right now, employment I think is going to kind of get overlooked to see what happens over the weekend with Italy and to see what happens with trade talks with China and such. Likewise, we have June FOMC coming up in the middle of June. That'll be the next event, at least on the calendar. But for now, I think the risk tomorrow's number is if it comes in weak, look out. We could see buyers come in with both hands. This is Todd Colvin coming to you from the floor of the CME Group.